Hi folks, Dr. Miller here, welcoming you to our second week of financial management. That's ADMN 930 at the University of New Hampshire. And today we're going to look at an introduction to some of the concepts from our second week, which include the choice of corporate form of ownership to start with. I pause because there are several. We talk about the sole proprietorship, which is how my business is organized. We also look at a partnership or a more recent limited liability corporation, which is a more recent, more popular form of corporate organization. We also touch on the balance sheet model of the corporation and the financial manager, which we'll speak of in more detail later on. A very important topic is the importance of cash flows, which is never discussed enough. Cash flows form the valuation of any economic asset, whether it's a stock, a bond, a business valuation, or real estate investment. Cash flows are economic oxygen. Cash flows form the backbone of valuation for all economic entities. Another broader idea or concept is the goal of financial management and related goals of financial management. And while the goal of financial management is generally accepted to be maximizing shareholder wealth, a related and more important goal, I think, is how the goal of financial management trickles down to society for the betterment of society, and how the goal of financial management benefits employees and shareholders and communities as well. Another problem that many of you will cross is the agency problem that many shareholders have with hiring managers. At the core of the agency relationship is an issue of trust, whether the shareholders can trust whether the managers will act in the stockholders' best interest, whether the managers will align their interests and their needs with those of the owners of the corporation. We also touch on briefly on the Securities Act of 1933 and the Securities Exchange Act of 1934, which gave rise to the Securities and Exchange Commission, and a more recent act called Sarbanes-Oxley, which was passed in 2001 as a result of the fallout between Enron and Arthur Andersen. I was there during that time. I was a manager for Arthur Andersen and watched as Enron's financials just really went off the charts. We will touch on conceptually the balance sheet and the income statement as being two of the more recent and not more recent but most important financial statements, and why understanding financial statements and understanding how to interpret them is so important both to the manager as well as to the manager's ability, the MBA's ability to distinguish themselves in an interview situation. The balance sheet shows what a firm owes and owns. Same is true in a personal sense. And the income statement shows what the revenues and the costs and whether any dividends are paid by a corporation. Taken together, the balance sheet and the income statement are two of the most important financial statements that are used together. The accounting statement of cash flows, which shows cash flows from operations, investing, and financing, is the nexus or link between the income statement and the firm's balance sheet. Generally, questions related to the firm's balance sheet or income statement can be solved by looking at the information contained on the sources and uses of the firm's capital, which is the cash flow statement or sources statement. When we talk about financial statements, or we talk about standardizing financial statements, we standardize financial statements because it makes them so much easier to understand and read and interpret and analyze, especially through time. Typical financial statements are shown in terms of dollars. Standardized financial statements are shown in terms of percentages. On the balance sheet, for example, each line item is shown as a percent of assets, whereas on the income statement, each line item is shown as a percent of revenue. Much easier to compare common size statements, especially as we're comparing companies in similar industries. Ratio analysis is so important to what we'll be doing as both MBAs and managers. I just want to mention briefly there are 5 diagnostic categories. These are not the ratios themselves, but the 5 diagnostic, we are financial doctors. The first is the short-term solvency or liquidity measures. Second is the long-term solvency measures, second diagnostic category. The third diagnostic category for analysis is related to management quality or asset management and turnover measures. The fourth diagnostic measure relating to our ability to understand the firm is the firm's profitability measures, generally measured different ways in terms of net income as a percent of sales, net income as a percent of assets, and for example, net income as a percent of return on equity. The final diagnostic measure that we'll look at is market value measures, generally measured in the price-earnings growth ratio. And taken together, these 5 diagnostic categories, in which there are 2 to 3 ratios per each, form the basis of our diagnostic ability of the corporation. The DuPont identity allows us to break down the return on equity components into their component parts to see where the problems are in the corporation. And let's see what else we'll be looking at. We'll be looking at firms' external financing and growth, the need for additional assets, financial policies, a note on whether we are working for a firm that can sustain its own growth, and we'll be examining some caveats regarding financial planning models. Hope you enjoy our second week. Look forward to working with everybody. Thanks.